Welcome to The Explainer. Today, we're going forensic on a really nasty tax trap that's catching tons of U.S. residents who have Canadian pensions. If you're getting CPP or OAS payments, listen up, because you might be paying way too much in taxes and not even realize it. Let's fix that. So let's just cut right to the chase, shall we? Are you paying taxes to both the Canadian and the U.S. governments on the very same income? For way too many retirees, the answer is a big, frustrating yes. And it all starts with a single number. So this is the number, 25%. This is the default non-resident tax that Canada's Revenue Agency, the CRA, just automatically withholds from your pension checks. It's their standard procedure, but for you, it's the first step into a really expensive trap. Okay, so you see that 25% was taken out, and you do what seems totally logical, right? You file Form 1116 on your U.S. return to claim a foreign tax credit. I mean, you paid a tax to a foreign country, you should get a credit for it here. Makes perfect sense. But this is where it all goes wrong. The IRS flat out denies the credit, and just like that, you're stuck. You've paid 25% to Canada that you can't get back from the U.S., and you still owe U.S. income tax on the whole pension. You've officially been taxed twice. To figure out why this happens, we have to dig into the U.S.-Canada tax treaty. What's kind of wild is that the entire solution to this mess is actually hidden in plain sight, right inside the U.S.-Canada tax treaty. It all boils down to a really critical change that was made a couple of decades back. You see, before 1996, the rules were simple. Canada had every right to tax your pension because that's where the money came from. But in 1997, a protocol to the treaty flipped the whole script. It switched everything to what's called residence-based taxation. And that just means the country where you live, and only that country, gets to tax your pension. And here it is, the smoking gun, right from Article 18 of the treaty itself. Now, I know that sounds like a bunch of legalese, but what it's saying is crystal clear. If you are a resident of the United States, your Canadian Social Security benefits are taxable only in the United States. Canada literally signed away its right to tax you. So here's the kicker. When Canada withholds that 25%, the IRS looks at it and says, hey, wait a minute. The treaty says you didn't legally have to pay that. They see it as a voluntary or non-compulsory payment. And the IRS will absolutely not give you a tax credit for taxes you weren't actually required to pay. You essentially just gave the Canadian government a donation. Now, let's switch gears and look at your U.S. tax return. Because if you do this the right way, you can turn this rule into a huge advantage for yourself. Okay, this is probably the single most common and most expensive mistake people make. Your Canadian pension is not just some random foreign pension. Because of the treaty, it has to be treated exactly like U.S. Social Security. That means it absolutely does not go on line 5 of your 1040, where every penny is taxable. It belongs on line 6A. And why does that one little line change matter so much? It's all about this number. When you report it correctly on line 6A, you get the same special treatment U.S. Social Security gets. That means, at most, only 85% of your benefits can be taxed. For a lot of people, it's even less than that. But no matter what, at least 15% of your Canadian pension instantly becomes tax-free on your U.S. return. But, believe it or not, the treaty offers even more than that. It's not just about fixing the tax credit trap. There's another really powerful protection built in, especially for folks with higher incomes who are getting old age security. So, in Canada, if your income goes over a certain threshold, the government starts taking back, or clawing back, some of your OAS payments. Well, guess what? That clawback is legally considered a tax. And since the treaty says only the U.S. can tax a U.S. resident's benefits, Canada is prohibited from applying this recovery tax to you. Just by living in the U.S., you become totally immune to that Canadian means test. All right, we've got the legal framework down. We know the why. Now let's get to the practical part. How do you actually stop Canada from taking this money in the first place? The main tool you need is a form called the NR5. Think of it as your formal application to the CRA to stop withholding tax. You're basically raising your hand and saying, hey, I'm a U.S. resident and I'm protected by the treaty. You'll want to file it before October 31st for the next year, and once it gets approved, you're good to go for 5 whole years. Okay, so that's great for future payments, but what about the money that's already gone? If you've been losing 25% of your pension for years, the good news is you can get it back. But, and this is important, you're not getting it from the IRS. Let me be perfectly clear about this. The U.S. government is not going to fix this for you. You cannot go back and amend old returns using Form 1116. That ship has sailed. The money was taken by Canada, and you have to go directly to the Canada Revenue Agency to get it back. Now, you've got two main ways to do this. The most direct route is filing Form NR7-R, which is basically an application for a refund of tax that was withheld by mistake. The other option is to make what's called a Section 217 election. This just means you file a special type of Canadian tax return. And since the treaty says your tax rate is 0, it should result in a full refund. Okay, I know that was a lot of detail, so let's wrap this up by boiling it all down into a simple, actionable checklist. This is your game plan. Here it is. 1. Stop the bleeding. File Form NR5 to prevent future withholding. 2. Report it right. Put your CPP and OAS on line 6A of your U.S. return, never line 5. 3. Never ever claim a foreign tax credit for this. 4. Go get your money back from Canada using Form NR7-R. And 5. Verify you're not getting hit with that OAS clawback. Follow these steps, and you'll patch this major wealth leak for good. It's pretty amazing when you think about it. Just understanding this one single rule buried in a complex tax treaty can literally save a person thousands of dollars year after year. It's a powerful reminder that sometimes the thing you don't know is what costs you the most. Which really leads you with one last question to think about. What other hidden administrative errors could be quietly draining your retirement portfolio right now?